It's a Wednesday morning. You wake up and you check your phone. Markets are collapsing already in the morning. The S&P is down a massive 8%, even before the open. Oil is up $25 overnight. Gold is exploding, or it's collapsing, depending on how the market is viewing all of these developments. And the news is more frenetic and chaotic than ever before. Now, Russia has escalated in Ukraine. Iran is launching a regional war. Israel is ramping up the ante, and America is sending more and more troops. Iran has threatened to close the Strait of Hormuz, and they've gone even further, they've mined it. China has announced military exercises around Taiwan. On the television, all of the analysts are saying the same thing they always say.
Unexpected.
Unpredictable.
On television, analysts are saying the same thing they always say.
It's unexpected. No one could have foreseen this. This is a black swan event. It's so unpredictable right now what's going on in the world. Who could understand this chaos and this frenetic activity? It's such a geopolitical shock. What's going to happen? We never knew it was going to occur like this. No one could have predicted this. But deep down, you all already know that something isn't quite right. It hasn't been quite right for a very long time, because markets don't fall like this out of the bed from just one news event. They fall like this when the system is already incredibly fragile, and suddenly everyone realizes the structure underneath it was always inherently unstable. It was always inherently unmanageable. It was always just fundamentally incapable of sustaining the kind of pressures and the debt loads that it has now. Suddenly, doesn't seem so sudden anymore. It seems as though it was ordained, it was predicted, there was a predisposition to all of it. Now, the next epic financial crisis is approaching. And some may already say that it's upon us. Just like the World War, you never really know when it's the World War until you look at it historically. But this time, this financial crisis isn't just about war. It's not just about politics. It's not just about the burgeoning income wealth inequality between the rich and the poor, the haves and the have-nots. But it's because global financial liquidity, the financial system that we all rely on every single day, is now sitting on a dangerous precipice. A dangerous combination of record debt, tightening liquidity, huge strains in the markets, and rising geopolitical instability. And that combination has triggered almost every single major financial panic and crash in history. 1914s, 1920s, 1930s, 1970s, 80s, 90s, 2000s, 2020s now. And the mechanism is always the same. It's always simple, but the pain and the fallout never is. Too much debt, meeting in a world that is becoming unstable, meeting in a world where the liquidity spigots have been turned off, where the debt loads are too high. Most people are confused because the markets, up until recently, have looked relatively sanguine, relatively calm. But calm markets are exactly what the system looks like right before it breaks, right before it collapses. And by the end of this video, you'll see exactly where that pressure leaks. My name is Justin Bantam. This is the House of Trade. So let's talk about it. Let's talk about why the world is becoming inherently, structurally, more and more unstable. Look at the world right now. Wars in Europe, wars in Africa, wars in the Middle East, wars everywhere. Governments talking in such jingoistic, bellicose terms, such aggression we haven't seen in decades. Look at the world. Russia and Ukraine locked in a battle to the death. Brutal war. It's already reshaped energy, food markets, with Ukraine being the breadbasket of Europe. In the Middle East, Iran sits at the center of rising regional tensions that threaten global oil supply. Qatar, Bahrain, cutting off oil supplies. Strait of Hormuz completely blocked. And then we transport ourselves to Asia. The Taiwan Strait has become one of the most dangerous places in the world. One of the most dangerous, incendiary, inflammatory flashpoints in the globe. A war over Taiwan wouldn't just be political anymore. It wouldn't be geopolitical. It wouldn't be geostrategic. It would cripple the global economy, much like we are seeing right now in Iran. And these things have a history of being additive. That means they occur all at once. And when Taiwan is in charge of producing 90% of the world's most advanced semiconductors, that becomes existential. It becomes every AI system. It becomes every smartphone. It becomes God, every fridge, every washing machine, every modern weapons platform all depends on those ships and the ready supply of those chips coming in. If that supply disappears, even temporarily, even intermittently, if that supply disappears from the markets, entire industries stop functioning, entire supply chains collapse, and entire business models cease to exist as a going concern. Meanwhile, what's happening around the world? More conflagration, more incendiary events, more kinetic fighting between nations, escalating into the most apocalyptic World War III-esque scenario. But all alongside that, something even more pernicious is going on. Global debt keeps rising. Global debts keep piling up. And before every single massive world war, intergenerationally, it's always preceded by huge amounts of debts, inequality in terms of the asset holders and the liability holders. And with global debt now exceeding $300 trillion, before the financial crisis of 2008, it was like only 180 trillion, which even then is a massive number. But that means the world has added over $120 trillion of debt since the last collapse happened. But the debt only works when the interest rates remain low. And what's happening now? Governments are being threatened with having to raise those interest rates because of this huge energy shock going on around the world right now. Gas prices, oil pricing, up 90% in 12 days. For over a decade, central banks have tried to keep the cost of money down low. That's allowed governments to act profligately. That's allowed them to spend massive amounts of money. That's allowed them to have unfunded liabilities. But today's rates are threatening to go even higher. That means the system is now at a dangerous point of fragility, a dangerous reality where they can't fund themselves, where people are going to find it harder to get credit, where companies are going to not be able to borrow at around zero, and when debt is going to be treated like it should be in this paradigm, in this environment, which is risky as hell, okay? And historically, that never ever ends smoothly, and it won't end smoothly this time. So we have all of these supply shocks, we have these energy shocks, we have these geopolitical shocks, we have these war tensions, and then we pile on top of it AI, productivity, and the pièce de résistance, the demographic shock going on around the world right now. There's another problem building quietly under the surface. It's all about global demographics. China's population is shrinking. Europe is aging very, very quickly. I mean, Italy will never be able to have more young people than they have old people ever going forward in history. Europe is aging rapidly. Japan has been aging for decades. Even the United States is slowing down in terms of how many people have babies and how many people don't. But can you blame them? Populations are aging, economic growth is slowing, things are harder than ever, the cost of living is higher than ever, global instability, not being able to afford a house, affordability crisis. Can you blame anyone for not wanting to increase the natality rates? There are fewer workers, fewer migrants, fewer consumers, fewer loopholes, fewer ways to get ahead, fewer ways to achieve that so-called American or European dream. And when that happens, it all lowers productivity, it lowers growth, it lowers corporate profits. But the debt never stops. The debt gets harder and harder to pay back. The debt gets rolled on. The debt gets refinanced at higher rates, and it never ever seems to get any better. That's going to force governments to do a few things, but the most pernicious thing it's going to force them to do is to borrow ever increasing amounts of money into the future, which is going to mean the future generations, our kids, if you're lucky to have any kids or if you can afford to have any children, are going to be the ones who pick up the tab. Now, the energy complex is the true wild card in all of this. No one at the beginning of the year, even 2 months ago, would have ever forecasted that they would have seen this war with Iran reach this fever pitch level that it's reaching right now. Because when you add in the geopolitics, it gets even messier. The Strait of Hormuz, we know it carries roughly 1/5 of the world's oil through it. It is now veritably, effectively closed. If conflict involving Iran disrupts all of that stuff even longer, it's going to lead to global growth really diminishing really quickly. Energy shocks are one of the fastest ways to trigger inflation, irrespective of what the Commander-in-Chief, Donald Trump, says it being a temporary glitch or a temporary blip. Oil stocks have always done bad things for the economy. Oil shocks in the 1970s drove down global growth, increased inflation double digits. Central banks have to raise interest rates aggressively, and the global economy has to plunge into a recession. Today, that system is far more indebted and leveraged than ever before, which means the same shock is going to have way larger consequences. Liquidity is going to be constrained, and the central banks are going to have to revert to the same modus operandi, which is liquidity injections into the economy. But the real weakness of the modern financial system is not just the debt, it's the liquidity, it's the constraints, it's the lack of liquidity, it's the inability to fund those liabilities and for everyone in the markets to believe that you're good for the debt. Everything in modern finance depends on constant liquidity, constant capital, constant debt, bond markets, stock markets, housing markets, foreign exchange markets. Even government spending relies purely on debt. Now, when you can't fund yourself amply, that's when things start to seize up. Liquidity disappears, everything dries up. Everything becomes a crisis very quickly. Like in March 2020, when the US Treasury market, the most important financial object in the world, nearly stopped functioning. Central banks had to inject trillions of dollars into the market. That was during a pandemic. That was during an event where they could control and coordinate things quite easily. Now imagine a similar liquidity shock in a world that's far more kinetic, far more chaotic, and far more frenetic during a geopolitical crisis, during a wartime crisis, a paradigm that we haven't seen in decades. That makes the whole picture even more complicated, even more dire, and even more existential. And that's what leads us onto the hidden fragility of everything I'm talking about right now. Because financial crises rarely start when people expect it, and liquidity always disappears exactly where you need it. They start where the leverage hides. Big, huge organization building up opaque debt structures, huge nations building up massively unsustainable debt piles, corporations borrowing out long onto the curve and not being able to adjust when the debts come due. In 2008, we had a very different market. It was all about mortgage derivatives. Today, the potential weak points just aren't the same. But the thing about them is this: they are far bigger, far more dangerous, far more misunderstood, and far more opaque. Private credit markets, commercial real estate, shadow banking, sovereign debt. These areas have grown massively over the past decade. Not to mention the fact that all of these companies are spending trillions on an AI project that they don't really know for certain will actually pan out and bring back returns into the future. These areas are all growing unsustainably, and they all dangerously remain poorly understood, which makes them even more perilous, makes them even more dangerous. Because the greatest risk in finance, the greatest risk in financial markets is the risk that nobody fully sees. You have known knowns, you have known unknowns, you have unknown knowns, and you have unknown unknowns. And those are the ones that really come back to kill you. Now, talking about a known unknown, that is Taiwan in a nutshell. The Taiwan scenario probably is more cataclysmic to the entire world, and people are underrating it. It's the same way they underrated the risk of the fallout from the Iranian conflict right now. Taiwan's semiconductor industry is the backbone of the modern world, and I say that with zero hyperbole. If conflict disrupted those factories and that region, AI development would stall. All of the trillions of dollars being pledged would go to waste. Automobile production would probably collapse. Military supply chains would all break. Your refrigerator probably wouldn't be able to get spare parts, and the global economy would seize up and freeze like it had arteriosclerosis. Markets would not fall gradually in that scenario. They would seize up completely and probably be closed. And who could blame them? You have to protect the capital, you have to protect the mechanisms or transmission of money into the economy, and you have to protect the system that we've all become beholden to. The Iranian inflation shock is a different keg and bottle of worms. I can't remember what that phrase is. But imagine what this energy shock is actually going to cause in our world going forward. The Strait of Hormuz, it's being closed. Even if it's closed temporarily, it's an issue. But being closed from an elongated timeline perspective is a disaster. The modern economy is basically a function of transforming energy. Modern productivity is energy transformed. You need it for everything. Energy being transformed in productive means the economy grows. Energy without A world without energy means energy cannot be transformed, which means we cannot grow in the same way. At least we can't do it for as cheaply as we did before. So the central banks are in a real quagmire here, and they're going to have to respond if this gets elongated. If this isn't a quick war, they're going to have to raise rates really quickly to fight inflation that's coming down the line, or they're going to have to cut rates to save the economy. One of the two things are going to have to happen, but they can't do both. And this unpredictability, this uncertainty is what drives these risk assets lower and lower and lower. Now, although lots of this is unpredictable, there is one thing that stays quite consistent, quite predictable, and that's the pattern, because the pattern is always the same. History has always shown this same pattern, this same patternation, this habituation, this response function, this response mechanism many, many times. 1929, credit bubble. That meets the economic stress. 1998, a leveraged hedge fund exposes the world to risk. 2008, subprime mortgages, housing collapses expose the world to another plethora of risk. The trigger always looks different, but the mechanism and the outcome is always the same. Monetary printing, stimulus, rate cuts, coming in to save the economy at whatever cost, by any means necessary. The mechanism never ever changes. Too much debt, too little liquidity, quick responses from markets, inability for policymakers to come out and do anything meaningful other than print money, a sudden loss of confidence, debasement, risk models being readjusted, global conflicts, global conflagrations, always the same thing leading to a sudden loss of confidence, people running, retreating to what they know and trust the best. And what's going to happen in all of this is the same thing we all know before. They're going to get back onto the money printers. They're going to talk about a new acronym, a new four-letter word. The policy response is going to be swift. It's going to be coordinated, and it's going to make your money worth less, and it's going to make the people with assets ludicrously, ungodly more rich. And when that crisis arrives, governments are going to respond exactly the way, because there's nothing new under the sun. We always know what they do, and it's going to be the same because the only thing they can do, because the plumbing requires it, the plumbing necessitates it. The way the system works is the only thing that they can do. Interest rates are going to fall. Central banks are going to inject liquidity. Governments are going to talk about fiscal expansion. Money is going to be printed, because allowing the system to collapse is politically impossible. But becoming more indebted is the only thing they can do. It's far more favorable to let the system inflate than it is to let it collapse. Allowing the system to collapse is politically unpalatable, not because they care about you, not because they're not misanthropic, but because it keeps them in office. And the business of government is to protect government. They're slowly going to erode the value of money. They're slowly going to erode your value, your way of living, and your the status of your living, and the quality of your life. But it doesn't matter, because the system must be protected at all costs. So where does the pressure leak first? Where do you see it appearing? You're seeing it right now. It brings us back to the most important question. Where does the pressure leak? How does the exit valve manifest itself? Because financial pressure doesn't disappear. It just kind of transforms in a weird coefficient kind of way. It moves, it leaks, it transforms, it migrates. Historically, it leaks into real assets, which is why the current market reaction is so perverse and counterintuitive. You'd think that gold would be vertiginous right now, on a tear, but it's not. But that's more because of the dollar and because of liquidity worries and because of this risk-off mood. Energy, hard asset, commodities, anything outside the financial system that is not correlated at a one level, anything that's completely uncorrelated to what is the most risky proposition in this world right now, anything outside of the financial system. Because when the trust in that money starts to weaken, capital searches for somewhere to hide. And that's what's going to be happening really quickly right now. And if you haven't seen it already, then you're probably not watching it closely enough. Now, the good news is that the next epic financial crisis probably won't begin with war. So that's a small consolation, because war is truly hellish. It's not going to probably start with politics. It's probably not going to start with markets, as much as that might sound counterintuitive. It's going to begin with something else. It's going to begin because the financial system and the structure has quietly become unstable. It's become overloaded with debt, undergirded with faulty policies, underwritten by shaky foundations. And when the next shock actually arrives, geopolitical, financial, or demographic-wise, the world will realize something really quickly and very uncomfortably. The system was never stable at all. Everything you believed in no longer really works. Everything you thought was sacrosanct doesn't really carry the sanctity that you once believed it would. The world realizes it all at once, and that's what's dangerous. The system was never stable. It was simply waiting for the pressure to show up, for the pressure to leak, and the confidence to evaporate and disappear. And that's where we are right now. Protect yourself out there. Stay abreast of these markets. Look what's going on. Look at what the policy actors do rather than what they say. Look for the new acronyms. Look for a change in the media narrative, and look for a change in the narrative coming out of our elected officials. Those will be the greatest signals of when to reposition yourself. But for now, stay safe out there. My name is Justin Benton. This is the House of Trade. Ciao for now.